So the hidden dangers of Forex bots. This is a video that I just absolutely have to make. It's one of those things where I've seen so many people on the internet get promised the world and absolutely delivered nothing from people selling Forex bots. And after personally helping hundreds of people allocate capital to trading systems and actually deploying over $70 million of live capital to automated trading systems the right way, I can safely say that I know exactly what to look for, what to warn you guys to look out for, and what's either a good thing to proceed with or something you should entirely avoid. Not only that, but a lot of the things that these providers are doing, the people that are selling you these systems, they will never tell you any of this stuff. And it's something that you certainly need to know if you're considering deploying capital into an automated trading system that focuses in the FX market. Now, a lot of the stuff that goes on is simply illegal here in the United States, yet most people do it. And it's one of those things that will catch up to them down the road. But for you as the investor, this is one of those things that I just want to make sure you're aware of, because it could save you so much time and save you a lot of money. And in fact, the stuff that I'm going to talk about in this video could have actually saved people over $100 million. So let's dive right in. So first things first, I want to be very clear that I don't think there's anything wrong with trading currencies so long as you do it the right way. Now, what is the right way? Well, the right way would be trading it through a US regulated brokerage firm and trading currency futures through the CME. This way you have a centralized exchange for all your clearing, and you are trading through a US registered brokerage that's regulated by the NFA and the CFTC. In fact, most people out there are not doing this, and that is the problem, right? So most Forex traders that you see out there are typically trading currencies as CFDs, which are low quality derivatives of these regulated products. Now you might wonder, well, why do they do that? Well, there's tons of rules that these CFD brokerages are circumventing that you would not be able to do on a US regulated brokerage. In fact, most of these brokerages out there are registered in some, random island or some other country out there like Australia. And, for what it's worth, there's nothing wrong with Australia. But if you are a brokerage that's, based overseas and you are accepting US clients to trade on your brokerage, especially, products like currencies, then you are violating CFTC law. The CFTC is a federal organization in the United States that regulates commodities markets, and currencies are a product that falls under, their oversight along with the NFA. So that is one of those things to where if a broker is willing to accept a client to trade a product that is regulated in the United States, but they are not regulated by the NFA or registered with the NFA, then that is a huge red flag. And you might wonder, well, then why do people do that, right? And that's one of the things that I ask myself every single day, but I still don't understand why people do it. But there's a couple reasons why. Now, one of the reasons could be some of the flexibility. So in the US, there's a rule called FIFO or FIFO, first in, first out. So basically the first trade that you place has to be the first trade that's exited. Now, if you're stacking up positions, basically you're going to have an average fill price. Whereas with these CFD brokerages, you could, let's say, buy one at, let's say 100, right? I'm just making up a random price. You buy one at 100, you buy one at 102, you buy one at 104, you buy one at 106. Well, the way it looks on your trading platform is that you have all these separate open positions rather than one aggregated position. And you could actually close out, whichever specific one you want at any time, right? So that is a nuance that you cannot do on a US regulated brokerage. They just aggregate the entire position to an average fill price. So aside from that, there's no overnight margin requirements. So in the United States, if you're going to be trading currencies as futures products through the CME, you're going to have, initial margin, maintenance margin, and you're going to have overnight margin. Overnight margin significantly increases compared to initial or maintenance. Most people simply would not be able to maintain their types of trading strategies if they were doing such thing. Additionally, a lot of people out there, specifically, I will say, personalities that are Forex traders and also software providers that are selling algorithmic trading services to Forex brokers are getting kickbacks on commissions from the people that they refer. Now, they are doing so in a way where they are not registered, right? They are not registered introducing brokers, and that is going to be a violation. So in the US, if you want to receive commissions from people trading, then you need to be a registered introducing broker with the NFA. If you do that, then you can receive commissions from trading, no problem, by the book. But these people, are just getting affiliate links and, letting people sign up on this brokerage like they're selling you some random product online and they're getting a kickback from it. So there's a lot of things that favor people that profit from directing you to be there rather than you as the trader, if that makes sense. So there's a lot of specific nuances that are not in your best interest, okay? as the actual trader. Now, as the broker and as the people that choose to circumvent these rules, there's ways and reasons for them to gravitate towards that than doing it the right way. If you're trying to actually trade currencies and do it the right way, and you want to be an honest trader and an honorable market participant, then you should probably trade it through the currency futures product. But most people don't do that, and for whatever reason. Another thing with these brokerages is that if they are doing such type of activity, right, where they're accepting, US customers without having the proper registration, they can get shut down. But not only that, the person that's actually running the brokerage is basically pooling all the funds together all in one spot, and they could be misappropriating the funds. Now, in the United States, if you're going to be a brokerage or an FCM, an actual broker, not just an introducing broker that's, facilitating customers and doing that sort of thing, but you're going to actually be, sending trades for clearing and doing things like that, then you are actually going to need to segregate those accounts, right? So if you're going to be the custodian of these people's funds, then you need to segregate their capital into their own accounts. So this way it doesn't get mixed up with operating funds. Now, the thing that these offshore brokers do is they can do whatever they want. They'll take the funds, pool them all together, misappropriate them, use them for whatever else. And it happens all the time. There was an instance of a company called the Trader's Domain. They lost over $144 million of people's money. And whether they lost it or misappropriated it, I'm not the judge, but I think you know which way it's leaning. Either way, everybody that had an account over there didn't get any of their money back. And that was years ago. That was like 5 years ago, going on 6 years ago. And over $144 million, was taken from, honest people in that particular one instance, right? And that could have been completely avoided had they just used a US regulated brokerage. So again, it's just the very basics, right? And unfortunately, the waters are so murky when it comes to the Forex space and the currency space that a lot of people just don't know any better. And that's the problem, right? So especially people that are selling products for this market, they don't even know any better. They don't even understand the infrastructural flaws there. And that itself is a huge, huge problem. So obviously, the security of your funds, if you're sending them to some type of custodian, is going to be a huge issue. You always want to make sure if you're sending funds to a brokerage that's going to be acting as a custodian of your funds, that they are segregating those funds into an account that is siloed off just for you and is not getting mingled with all the other operating funds, or it could be stolen and misappropriated for other circumstances like it was in the Trader's Domain. Okay. Now, another instance where that happened was a company called FX Winning. They basically, were an offshore brokerage. They accepted all these deposits from customers. It was supposed to be used for, automated trading currency products, and probably trading gold as well. And again, all the money was stolen. And that was actually pretty elaborate. So how that particular whole thing went down was they were accepting deposits. They were giving customers fake brokerage statements because they're a broker that's breaking the rules already, right? So what they're doing is they're generating fake trading statements. They're making it look like all these trades are happening in this account. People were seeing this growth in their accounts and they're like, wow, this is amazing. It's working so well. But when they went to go ask for withdrawals, nobody ever got their money. And that was an instance that I think defrauded people from about like $26-ish million. So you got $144 million from Trader's Domain, basically a bunch of funds being misappropriated, and because of the lack of segregated client funds, nobody was able to get their money back. And then same thing here, with FX Winning. A bunch of people made these deposits into a Forex broker that was supposed to be used for a Forex trading system. They got fake brokerage statements and thought they were doing so great, and nobody was ever able to get a withdrawal, and all the money just went poof, vanished. And same thing with Trader's Domain. That was another like automated trading system thing, and that was like the solicitation for it, and none of the money was ever used for that. They also got fake trading statements. So when you're not following the rules that the NFA lays out for you, and that is going to be overseen and enforced by the CFTC, a federal organization, you don't know what you're getting yourself into, and that's a big problem, right? So especially, recently, a lot of people have been directing money to, United States citizens have been directing money to brokerages based in Australia that are not registered with the NFA. And you can verify any NFA member's registration through the NFA basic search, but these people are not registered. They're sending money over there, and you don't know what's going to happen. Like that money could literally just disappear whenever, and people are not going to get their deposits back. And the problem is they're being directed to these brokerages, not on their own, finding, right? They're not doing research and like, oh, I'm going to go open an account here and go start trading there on my own. The problem is they're being directed there by vendors in the space that are selling trading software, trading algorithms to open accounts over there. It's not in their best interest. They're depositing money at a custodian that could simply just vanish with all the deposits. And not only that, the only reason they're even opening an account there in the first place is because they were told to do so by a company that's benefiting from getting commissions from the trading from their trading system on this brokerage. How does that benefit the customer in any way, shape, or form? It doesn't. It just benefits, one, the person that's soliciting them a service, that they were going to use that service through this brokerage and they're going to be getting the commissions, and it benefits the custodian. Be very, very careful. Don't fall for this type of stuff. It's incredibly dangerous, but these are just infrastructural risks. We're not even talking about any actual trading risks with these services, right? All we're talking about right now is the third-party custody risk that you're subjected to by the referral of the person selling you the Forex trading software. So again, I might be making this sound complex, but it really isn't, right? There's one party that benefits. There's one party that wants to benefit, which is you, for buying a service, but really you're just putting yourself in a really bad situation. So just avoid the third-party custodian thing. If you can avoid the offshore custodian risk, you are already ahead, okay? So that's one thing. Again, I have nothing against people trading currencies. Nothing at all. Just do it the right way. Don't send money to an offshore custodian if you are based in the United States. Don't do it unless they are registered with the NFA as an actual FCM. If they're doing that, then that's okay. If they do not have any type of registration with the NFA, do not do it. Very simple. That's it for that topic. Next, dangerous trading practices. A lot of these companies will sell you a system that holds these trades forever. And when I say forever, I don't actually mean forever, but I mean a very prolonged period of time. They could be in, certain types of positions, maybe for 1 month, 2, 3, 4, 5 months. And they're just waiting for these trades to turn around. And that just would never be able to happen if they were doing it through a US regulated brokerage because of the overnight margin requirements. So basically what will happen is they'll get these brokerages overseas. They give you like 1 to 500 or 1 to 1,000 leverage, which is just absolutely ridiculous. They'll get you in all these positions, and then the positions will go into drawdown, and they'll just let the trades that are in drawdown, they'll just leave them there. They'll just let them stay open. And then when those trades go into profit, then they'll start closing them. So they'll only close the profitable ones, and they'll let the ones that are in drawdown just linger there. And when I say this term drawdown, if you're not familiar, I mean they have negative open P&L. They are losing positions, right? If you were to close them, you would lose money. So they have these positions that have open losses. They leave them there, and then as soon as they turn profitable, they close them. Would never work on a US regulated brokerage because of the overnight margin requirements. So they got to go outside the lines. They got to start coloring outside the lines a little bit to make that work. And then obviously they have the FIFO rule that they're circumventing, by doing that, which allows them to do such thing. You would also not be able to do that on a US regulated brokerage because of the FIFO rule. So again, there's all these like weird little things that they're exploiting to allow you to do such type of practice, right? And just, you don't need to go that route to accomplish this type of thing. So you just shouldn't do it. So they'll do that so they can open all these positions. But the problem is when all these positions are being opened is they're letting the ones that are losers just sit there and just, fester until they turn positive. But the issue is, what if they don't turn positive? What if it gets worse? And it does get worse. It's not a matter of if, it's a matter of when. So if you wanted to pull all your money out, let's just say you're like, all right, screw it, I'm done with this. And you want to get out, pull out your capital, send it back to your bank account and move on. Well, you have to close all those open losing trades. And the problem is with these Forex companies is they will only show you, they'll track your results on MyFXBook, which is a third-party verification platform. And what they'll do is they'll only track the closed equity balance of the account. So you'll see an equity curve that looks like this, but it's only on the trades that they actually closed, right? Remember what I told you, they leave all these other trades open, right? And because they're circumventing the FIFO rule, they can close the profitable ones and leave the open losing ones just there to sit. Let's say you have a $100,000 account and you've got $20,000 in open losing positions that are just sitting there. Well, if you want to pull all of your money out, you need to close all of those losing trades to get your cash out. So maybe on paper with your third-party MyFXBook verification, maybe you're flat, maybe you're up a little bit and you just want to move on. Well, now you have to close that $20,000 drawdown, and then you're going to take a $20,000 loss just to get your money back. And then you got to hope and pray that the broker's actually going to send you your money back, right? Because they're offshore. They don't need to follow our regulations, right? They can just take your money and run away. It happened. Look at Trader's Domain. So yeah, that's another risk. And there's people out there that are selling these types of systems that I think genuinely have good intentions. They just don't even know this stuff themselves. I mean, they don't know that a better way exists. And it does. You can just trade currency products and gold, if we're bringing up gold into it, through the futures markets. I mean, that's how they trade. That's where they trade. So just trade them through those markets and you'll be good to go. But a lot of people don't do that. And, you have to ask yourself why, right? And, I gave you a couple good reasons why right now. There's a lot of things that they're exploiting for their own benefit, which makes it, obviously not very advantageous for them to do it the right way. And maybe their systems just wouldn't even work in U.S. regulated brokers if they had to follow, the FIFO rule and things like that. So aside from that, another huge risk that you run into with these Forex systems is Martingale, right? So Martingale, you can do that. That could happen in US-based brokerages. That could happen on any other type of instrument as well. It's not just limited to Forex, okay? So I just want to make that clear. I'm not the Forex hater here. It's just a matter of how you do it, right? That's all it comes down to in the end of the day. Martingale, basically this is where you double down on your losers until you make your money back. So let's say, you start with an initial trade, you risk $1, right? You're wrong, so then you risk $2. You're wrong, then you risk 4, then you risk 8, then you risk 16, so on and so forth until you make your money back. And the problem with this is that you have a limited amount of money, and this could happen at a very, very fast pace to where you start taking on a very large position very quickly, especially with an automated trading system, and you just get completely blown up. And this happened, very recently. I mean, honestly, it happens every year, but there was a huge, huge incident in July of 2024 where a lot of people lost a lot of money from a certain vendor that was selling an automated trading system in the Forex market, and they got completely blown out of the water because they martingaled their way into a move that went against them, and it blew all their customers' money. And this is just one of those things that is so negligent, so unethical, and it's just one of those things that it's really sad to see because one, a vendor should clearly disclose this type of risk. That particular vendor was pitching their products as like basically a fixed income product. You're going to get X% a month and, blah, 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 blah. And then they just literally blew someone's entire account overnight. So that's not good. But yeah, so obviously you don't want to be doing any type of martingale stuff. And you definitely don't go into this for a fixed income product. I mean, algorithmic trading systems, I made a whole video on this. It's called, Is Algorithmic Trading Right for You? And it basically goes over, all the things you need to consider. And, going into algorithmic trading as a fixed income product is simply not the right approach, but especially not a martingale system nonetheless. So it's one of those things that if you're going to be trading a martingale system, you should disclose it to the user. Let them know it's a high risk system. And if they accept the risk, then fine. The user's aware, they know the risks, they're going into it, knowing that it could get really bad really fast. And that's fine. That's a negative skew strategy. You have a lot of small winners and occasional very large losses. Most traders are negative skew traders anyways. They also don't make money. So there's that to it. But it's just one of those things to consider. If a trading system is using a martingale strategy, that it could get very, very bad very, very quickly. And it can go very well for a very long time. And then it could all just go poof in one day. And then just know that the vendor is probably not going to take accountability for it. And they'll probably just blame you for having some wrong setting in place. So again, I don't want to see that happen to you guys. That's why I want you guys to be aware of this. You can literally look it up on Wikipedia. It literally explains how it's a thing. There's an entire research paper dedicated on the martingale system in Forex systems and how it's used to fool people. So far we've covered third-party custodian risk. So any type of offshore brokerage, don't do it. I mean, you're basically just acknowledging that you could never get your deposit back. Another thing that we've talked about is the martingale risk, so definitely make sure that you're aware of that. And, also just, these brokerages that are circumventing FIFO rules through these products is very dangerous because, these types of things leave you in a position where you could have all these open losing trades. And if you ever want to get your money out, you have to take a massive hit, and that's just not a good thing. So again, there's nothing wrong with having positions in currency products. There's nothing wrong with having positions that are held overnight, but they shouldn't be held for multiple months in drawdown and you're just waiting for them to come back, because typically if you're in a position for that long and it's not going your way, it's probably not going to turn around. So that's just one thing to consider, and just relying on these MyFX book verifications is just not good practice either. So again, for the reasons stated, they're just following the closed trade equity rather than the open positions. So it doesn't matter if you have an equity curve like this all in your closed trades, if you have a 20% drawdown or a 30% drawdown just sitting in the account and you have 1 to 500 leverage, so you're just able to sustain that until you aren't. It's just a recipe for disaster. So yeah, there's a better way to do things. There's a right way to do things. And I just really hate seeing people, get screwed over by, people that are soliciting these types of products. And I also hate seeing traders, participating in Forex markets the wrong way and actively trying to become good traders, because, it's a worthy thing to pursue. But I definitely think that you should do it the right way. If you want to trade currencies, go for it, man. But go do it through, a regulated futures brokerage. Trade the currency futures. They have micros as well. So you can do it with, not a lot of money too. There's no reason why you need to actually use an offshore unregulated brokerage. There's no justifiable reason for it at all whatsoever. Simply, you just don't know any better. And that's okay to admit. It's okay to admit you don't know any better. Learn and then go do it the right way. But yeah, so don't subject yourself to any types of unnecessary risk if you don't have to. The purpose of this video is to educate you on said risks. But yeah, like the Martingale approach, that was a gambling strategy from 18th century France. I didn't write it. I've got no affiliation with it, but I think it's an awesome resource on the internet. I think everybody should read it. Here it is right here. It's called The Art of Financial Illusion. So definitely read that. It's an 18-page read. It's well worth your time. And yeah, it's just one of those things to where when you learn about this stuff and you really understand the risks involved and knowing that there's better options out there, there's no reason to ever go down the other path. So with that being said, I hope this video educated you. I'm not saying any of this stuff to slander anybody or to, scare you or any type of thing like that. I really just hate seeing people with good intentions lose a lot of money and, in situations they could have completely avoided. So with that being said, if you want access to systems that trade in US regulated brokerages, US regulated markets that don't use any type of martingale strategy, click the link down in the description, book a call with the team at Algo Exchange. We run over $70 million of live capital in US regulated markets and US regulated brokerages. We have live track records that show all of our actual performance, and we'd be happy to see if it's a good fit for you. So hope you guys got some value out of this video. Make sure you guys like, comment, and subscribe, and I'll keep making more videos like this. So I'll see you in the next one. Take care.